So when your net fixed asset turnover is less than 1, then almost 52% of the companies have given negative return. But when your net fixed asset turnover is between 4 to 6, only 37% of the companies have given negative return. So still you have many companies. If every 3 company in one company has given negative return, but here every second company has given negative return. So if your asset turnover is less than 1, there are higher chances of failure. And if you see, this is almost a 41% jump in chances of getting negative return. Also, in terms of positive return, so when you have a net fixed asset turnover of less than 1, only 24% of the companies have given positive return in that 3-year period, which means every 1 in 4 company will be able to generate more than 20%. But when you go with this, every 1 in 3 company will generate, which is almost a 31% fall in chances in getting greater than 20% return. So this is how you have to read this particular data. Also, what I want to highlight is, see, if you are investing in this bucket 4 to 6 return, your mean CAGR of all this bucket is 12.3%. So directly from 7.2% aggregated return, instead of that, if you pick companies only in this bucket, your aggregated return becomes 12.3%, which says that if you are investing with the right fundamentals, your probability to generate higher returns increases. Getting a negative return. So 37% becomes 52%. The difference is 15%. 15% divided by 37% is nothing but 41%. So so many times what happens in bull market, we get greedy and we compromise on quality. So the question is, how much in probability you are risking yourself when you are compromising on quality, and if you can consider this as one of the quality metric. So just by doing this, you are increasing 41% chances to get a negative return, and you are reducing your chances by 31% to generate a more than 20% return. Now, how I use it is, I use multiple such metric, and when you combine multiple such metric, the multiplicative impact of getting a negative return or generating more than 20% returns become much higher. So if I get a company where I see all the 5 signs are bad, it's an indication that I have to be, compared to a general investment, here I need lots and lots of caution. The valuation has to be extra attractive, extra margin of safety, because my generic probability says that here my chances to win is very less and chances to lose is very high. So this was one metric. Same way I'm taking another metric now, return on capital. So again, one question. What is a good return on capital? What is the return on capital you would like to invest? And why?
You can answer on the chat box, anyone. Mohit, you have given a good answer, above cost of capital.
15%. Why 15%? Above cost of capital, good. So that you can recover your cost of capital, and hence you are generating a sustainable profit so that you can redeploy and you will not get into that debt trap cycle. Okay. Yeah. Now we tried to do the same thing here. We tried to see if I arrange all these opportunities in terms of return on capital bin, less than 0%, 0 to 5%, 5 to 10% return on capital, 12 to 20%, and then see where how much return we are getting in each basket on a 3-year CAGR basis. Again, companies which have less than 5% return on capital, negative returns, even less than 5 to 10% also less than FD return. Only when you had a more than 12%, then you are getting into 7. So maybe you could have broken it to 12 to 15, more than 15, whatever. But the decent return came in, this band. More than FD return came in this band, and this is the best band. But it doesn't mean that higher the return on capital, higher will be the return, because even if you are having a 40% return on capital, it doesn't mean you are going to get extraordinary return, because the other factors come. And if you have a very good return on capital, very high, but you don't have opportunities to deploy that money and drive growth, then that return on capital is of no use. We all talk about it. Data also proves that.